Welcome to the Virtual CPA Success Show, where we're 100% focused on helping service-based businesses achieve success. Are you a business owner interested in learning how to scale your business? Has your business reached over $1 million in annual revenue? Then this podcast is for you.
Hello, everybody, and welcome to today's episode. Today is going to be a hot topic episode. One of the issues that we see out there with our clients, as well as emails and questions we're getting, are about acquisitions. So I think right now is a time when a lot of acquisitions are happening, and a lot of companies are either thinking about selling or thinking about buying, and there's a lot of different reasons for that. But one of the things that we want to talk about today is, it doesn't matter what the time is. You should always run your business like you're ready to sell it. And we're going to kind of talk about what that means, both from a financial perspective as well as a decision perspective. So in order to have this conversation, of course, we have Jody Grunden here, our owner and CEO.
Yeah, again, thanks for having me, Jamie. I'm really looking forward to hearing Greg's perspective. Greg's been with us for just about a year and works with several clients in this space. And so I don't know if he's got many clients that are in the selling part, but it'd be interesting hearing what their thoughts are leading up to that. So looking forward to hearing the conversation.
Yep. And like Jody said, so we also have Greg Wallace here, who's one of our trusted CFOs and does a great job with all of his accounts. So I know he has a lot to add to this conversation.
Thanks, Jamie. Appreciate the introduction. Definitely looking forward to chatting with you two about this. One of the things that I talk to my clients about every month is just where are they on the valuation scale. So it's a constant discussion, and there's a lot of activity in this space right now, and so just relaying that information to them and just making sure that if the opportunity arises, they're ready to move forward.
Awesome. So I think the best place to start for me, and I think the things that when I work with clients and I work with other CFOs on this, is probably in the due diligence area. I think that anytime you go through an acquisition, you are going to have to do due diligence because the buyer wants to know what they get. And so, Greg, for any company, is the best time to start due diligence right when it's happening, or what would you recommend in terms of keeping your books clean?
Yeah, well, I think you've said it correctly. Is making sure that you have clean set of books. That way you know where to start, and you're not going to have surprises that come out during due diligence. There's usually a third party, like an investment banker, that's going to be involved in that transaction. They're going to come in, they're going to scrub your books, and you don't want to find out that you've got assets that have no value that are still on your balance sheet, or you've got unrecorded liabilities. So one of the things that, we try and do at Summit is make sure that we've got, a good balance sheet review going all the time, or at least quarterly, so that at any point in time, those accounts are reconciled, what's in them, what's got a value that you can sell. And conversely, if you've got liabilities, you know exactly what those are capped at, and you don't have anything that is a surprise later. Because the last thing you want to do is negotiate a price and then have some accountants come in from the other side, beat it up, and then take down your purchase price to a level that you're not expecting. So,
yeah, because I think really when it comes down to it, the due diligence or the being prepared, I guess, for a sale is such a huge factor, because it really dictates the multiple that the other firm is going to give you. Because again, a multiple is just simply an estimate of what the value is worth, right? It could be a 3 times EBITDA, it could be revenue multiple, it could be really a lot of different things. But the cleaner and the less risk that the client is willing to take, or the prospect's willing to take, will increase that multiple for you. And so if they know that your books are in perfect shape on the accounting side, because we mentioned a little bit about the accounting jargon, the balance sheet and stuff like that. But if you've got the KPIs put in place, you've got your forecast dialed in, not just a throw together forecast, but something that you're currently using and monitoring and managing, and the prospect sees this and sees exactly what you're doing and knows how you're doing it, miraculously that multiple goes up, because again, the client assumes that the risk is a lot less than if they came to you and you had, what is a balance sheet? Everything's on Excel, or I've never even seen it, or you got all these weird stuff in QuickBooks that you didn't know anything about, or whatever that might be. So I think it's super, super important if you want to get the maximum out of your business when you sell, and make sure that you have everything dialed in. strongly with the accounting, but also on the finance side.
Yeah, I think that to kind of second that, I think it's being organized, right? Like I have seen deals fall apart because every question that gets asked, the answer is, "Oh, let me go look into that," and then it's a week later you come back with a not great answer. And so I think having stuff documented, having things very easy to your close to your fingertips, so when they ask, "Oh, in January of 2017, what happened that month?" and you're like, "Oh, that was the month we had blizzards," and this is why none of our people could work because there were blizzards in our main locations, and like you're able to answer it that quick because you have it at your fingertips. It just shows that you're a type of business that is worth acquiring, and it's the value, like you said, goes up because it's like, okay, these people already know how to run this business. They already have some good decision makers in place that can answer these questions. And the same goes for reconciliations. If they give you a look at your balance sheet and ask for 7 reconciliations for accounts they don't understand, and you have them ready for them the next day with explanations in there of what's in there and what the balances are and how those things bring value to the business. Like, it just shows you being organized and that, okay, these people know what they're doing with their business.
Yeah, and I agree because, again, going through multiple acquisitions and basically over the last 20 years we've been doing this, you really do see the more that they can rely upon not you, the business owner, because you, the business owner, you really don't want to be you don't want to be answering those questions. You want that trusted advisor, whether it's a in-house CFO, an in-house controller, somebody that's actually working on your side, or even a virtual CFO like ourselves. You want that person to be able to answer the questions, because a lot of times, again, financials are Greek to a lot of people, and you don't want to answer it incorrectly. Not answering it or deceivingly or anything like that, but just simply answering it incorrectly because you didn't know. You don't know what that payroll liability is on the balance sheet. You've never seen it. You don't know what the history is. You don't know anything about it, and that's where it's going to be really important to have a strong person by your side that can really answer those questions and really help you through that process.
And to build on that, I think, one of the key things that I've seen in having, been on the sell side in the private sector, the key is the reliability of the future forecasts. An acquirer is buying your future cash flow, and you need to have a really detailed, very robust and supportable, defendable forecast that holds water, because there's a time element to a transaction, and if your results don't match up to the forecast you set out, that you put in print and are shopping your company on, then that's where doubt comes in and purchase price reductions become very detrimental. And I've seen more than one deal fall apart when they put out a rosy forecast that was sort of built on the back of a napkin, that the deal fell apart. People walked away because they couldn't rely on the numbers. So, having that discipline, having that ability to put that forecast in place now, monitor those, your actuals, and then make adjustments to your forecast so that you're constantly training your model. That'll serve you tremendously well long term, and will keep your purchase price bulletproof and free from adjustments.
Yeah, a funny story about exactly that is, I was the director of accounting here at Summit, so I don't really work with a ton with the clients right now, but I do help out with a lot of clients. And a couple months ago, one of our clients was at a stage where they were thinking about getting acquired, and the CFO was out for a week of vacation, and they were at the point where they're like, okay, we just need a final look at these financial statements in these forecasts. And that's exactly what I did. I kind of came in as an independent mind and said, okay, here's the story that your forecast is telling me. Your forecast is telling me that you're going to be able to grow 40% next year. How are you going to grow 40%? What's your marketing plan to do that? And I just went back and asked them like 15 questions about, this is the story these financials are telling me from a blind eye. So I think having someone do that is also really good. I think having the CFO who's involved with you is really important, but is there someone else that can take a look at your financial statements and your forecast and say, looking at the story, this is what it is. How can you support that? And I think that's really important, is just taking a step back and being like, okay, anybody that's going to build a forecast is obviously going to be optimistic. And so I'm going to look at it as an independent eye and be, okay, 20% growth, that's fine, but why? How? What are the steps you're going to take to do it? So I think having that independent eye is also really important.
Yeah, Greg, you mentioned that on the, because you've obviously been, a CFO for a real long time, or in that position for a real long time. You said you went through a few on the corporate side, where you were the seller. Without disclosing names or anything like that, can you kind of walk us through what your experience is on your side? So it kind of gives everybody a kind of a feeling of, hey, here's what we kind of should expect. Now, I know not all deals are the same, not all purchases are the same, but it'd be kind of neat to get your perspective, from start to finish on how things, kind of went through.
Sure. In my most recent transaction that I was working on, we had hired an investment banker, and sometimes it's an investment banker, sometimes it's another business.
And what's an investment banker, just for those that don't understand?
Yeah, so an investment banker is a financial advisor that specifically focuses on acquisitions or sale side transactions. They're the advisors that coordinate that sale process, either going out to find potential bidders, brokering your business out in the marketplace, or would be advising you if you're looking to acquire. They can go out and find targets for you as well. So they're sort of the real estate agent in a transaction. So they're brokering that transaction for you, and they're the ones that are have the experience, know what the multiples are, help direct the due diligence process, coordinate with attorneys. And really are your representative. And so sometimes you might have a business broker, you might have an investment banker. There's a number of boutique firms that certainly specialize, in the digital agency space. But the process started with, just getting the management team together, saying, hey, this is what we're looking to make. We're looking to sell. The investment banker went out, looked at the marketplace, identified a number of buyers. In the meantime, as the CFO, I was putting together various financial models, projections, making sure that our historical financials were all put together. Oftentimes, if you get to a point when you, after you've been out in the market, sort of shopped the business for interest, then you would get into a situation where you might sign a letter of intent, where somebody says, hey, I'm really interested in buying you. Let me sign this letter of intent. We'll go into an exclusivity period where the potential acquirer would then bring in their accountants, their attorneys. They would review all of the financial documents, do their financial due diligence. They will do legal due diligence. They will look at your HR policies, look at your any legal liabilities, any lawsuits that you might have had. Just looking across the business to understand, what are the assets, the liabilities, the risks of the organization. They'll meet with the management team to understand, what is the marketing plan. They really just spend a lot of time just going through all aspects of your business to make sure what they're going to ultimately make an offer on is exactly what they're expecting. And so there's financial models, there's narratives that get prepared to describe what what your client base might be, if you've got a particular niche, if you've got a particular technology that you specialize in. So that's what you're selling, right? Is this future revenue opportunity in the marketplace. And then, assuming that due diligence pans out, everything checks out, the forecasts are good, the numbers are good, the business story the narrative is good, the employees are, accretive, meaning it's going to add to the business. Then you'd get into an actual purchase agreement and negotiating a purchase agreement. And that's when the attorneys get really involved and you describe exactly, what are you selling? Are you selling, there's different types of transactions. I don't know if we can get into that in a little bit, but I'll pause there to get some other comments from Jody and Jamie on this.
Yeah, I think the
So go
Go
ahead,
ahead.
Jamie.
I was gonna say, I think that, yeah, obviously we talked a lot about the due diligence. I am curious about, explaining a little bit, especially for people listening to this podcast, about the different types of acquisitions. So I do think that we should go down that road so they understand that, there's more than one way to do this. I don't know if you had questions prior to that, Jody, but I do think we should go down that path.
Yeah, I definitely think so. And I want to kind of touch on the topic of the due diligence and kind of get a good feeling on what that really truly means. What do they truly look for? I mean, on the financial side, also legal and HR. I mean, that's those are three major due diligence areas that they're going to look at, and so you want to make sure you have them buttoned up. If you don't have your HR policy written down, probably now is a good time to do it. If you don't have your everything in place on the financial side, again, yesterday was a good time to do that. So I mean, I think due diligence is a really scary thing for a lot of people. They don't know what it means. And due diligence can be very quick, or it can be long, really horrible process. So, and that really depends not necessarily on the buyer, but that's really on you, the seller. How good are your financials in place? Do you have that HR policy updated, everybody signed, all the things that you should be checking the box off as a business owner that maybe you were loosely doing when you first started the business. At the point of prior to sale, you want to definitely have all that buttoned up to make that due diligence process go seamless.
Yeah, I think, to build on that, I mean, that gets into, if you've got a lot of contractors, they're going to want to review all of your legal agreements, both with your clients as well as your, if you've got employment agreements, if you've got contractor agreements, if you've got owner or any kind of an equity program or equity sharing program with your employees. Usually if there's something that's, if there's an event that's triggered based on the sale of a company, that usually will be borne by, that'll be your responsibility as the seller to take that out of any proceeds. So if you've got any agreements that says, hey, if the company is bought, you get X percent of this purchase price. So you're going to want to make sure you understand, what might be in your employment agreements. They're going to look at things if you've ever had any, if there's been any discrimination claims, any EEOC claims, if you've had any of those legal issues in the past, those will be brought out and reviewed just to make sure that, again, back to the HR policy, are your policies being consistently applied, and are they keeping, you out of trouble from that regard? And then certainly client agreements. One of the things that they'll be looking at is, do you have a recurring annuity type work? Do you have retainers that can, are signed year after year? And you have, if your clients are repeat and, bankable business, that's usually more valuable than, project-based work. That is more difficult to land and takes longer to land. So, looking and understanding your mix of and types of clients that you have is really important in the overall valuation of the company. So, just a few other thoughts that you want to consider as you go into this contemplation of a sale.
Yeah, I think I'm gonna give three scenarios here, and I think let me know if I'm off base, either of you guys, on either of these three. Okay, so kind of the worst case scenario of your business is everything's up here, right? Like all of your policies, all of your documents are in one or two or three people's heads, and you may have like those agreements and everything signed. Obviously, at some point they were signed, but they're on people's desktops and they're all over the place. And so when it comes time to sale, you're gonna have to do a ton of documentation. You're going to have to find all those files, organize them, and do all of that. So that's probably like the worst case scenario of where companies might be. I'd say the kind of the middle case scenario would be you have everything, you just don't know where any of it is. So you have taken the time to type things and write things up, but who knows, you're HR policy might be 6 years old and you might need to update it and things like that. But you have to kind of take the time to find the stuff and organize it. That's kind of that mid case scenario. Then the best case scenario is you are extremely organized. Everything's updated. There's dates on there of, okay, this is when it was updated, and you have all this stuff documented. You have everything very organized, and it's very easy to find, and you're constantly updating those things. So those are kind of, to me, when I've worked with companies, those are the three scenarios I've seen. And obviously the first one takes a ton of time to get ready for due diligence, and those are the ones that Jody mentioned that might last 6 to 9 months. The middle ones, a little shorter, but you're still not quite there yet. And then the last one, it's due diligence is so smooth, and the company comes in and be like, wow, okay, all you have to do is give them access to this one folder, and they're ready to go, and they're going to come back with less questions. And so that's kind of usually what I've seen as one of those three scenarios. Would you guys agree with that?
Absolutely.
Yeah, 100%. I think you nailed it around the head. And you definitely don't want to be in that first scenario. That first scenario is a killer. That's where your stock gets devalued, your price gets devalued, because they open up the hood and then realize it's not all put together yet. Whereas you want that when they open up the hood and look at that engine, you want them to be pretty impressed on what you put together and what's driving your company. Because again, you're not. It's not like you're selling an object. You're not selling a baseball. You're not selling a bat. You're selling an intangible, something that's actually generating income that you can't really see, feel, touch type of thing, because it's really an inanimate object. And that's the important part about it, is making sure that everything is really solid and put together, so that they don't have any reason to devalue it. And that's your 100% goal, is to get the most out of your business when you determine to sell it. And due diligence, doing the financials, doing all that stuff prior to is greatly important.
And on that note, I think, if you're in that first bucket where you're trying to put all this together, you're also still trying to run your business. And it's the most critical time for you to maximize your business, your revenue, your client satisfaction. And if you're distracted by having to put together all this documentation and answer all these questions, if you're not focused on the business and the business starts to fall off in any way, if your billable hours start to drop, then that's going to be viewed as a softness in your forecast. And again, it's so important to be prepared so that you can stay focused on the business. In fact, ramp up the business, because you want your trend lines always to be going up. You don't want them to be flatlining, and you certainly don't want them to be taking a downturn. Selling in a down market is, then you're just, you're bailing water, and you want to get the most for your company, and so you need to be showing upward trends and keep that going, and not be distracted by having to put together, 42 HR policies, everything else.
And I think the key here too is this isn't only, I know we're talking about sales here, but I think like what you said there is a great point for just running a business day to day. Like, if all this stuff is in your head and it's not documented anywhere, you're probably not running your business to the best of your ability. And I think this is something that, you should think about, even because I'm sure some people are listening to this podcast and maybe didn't even download it because they're like, oh, I'm not thinking about selling. I don't need that podcast. But what we're talking about is more important than that. It's like, okay, this is something you should do so you can run your business day to day, so you're not always thinking, okay, I'm hiring someone. Okay, where do I find that HR policy of what the pay scale is? Because I don't remember where I saved that. You want to be able to identify that really quickly, so you don't have to think about those type of things. And so I think that this is more for just important than just the sale process. And so as we're getting closer to time here, I do want to kind of hit on that topic you mentioned earlier, Greg. Can you kind of talk about the type of acquisitions there are out there so people can be aware of those?
Sure. The two primary acquisitions are either an asset purchase, where a company would come in and buy the assets of your company, and essentially buy your AR, your customers, your relationships, and take that and just begin to run your business from that point. And then you would retain any remaining liabilities of the company. Your company winds down, and that's really the end of it. And the other is a stock purchase agreement, where somebody comes in and purchases the company whole kit and caboodle, basically exchanges out your capital or equity structure replaces that with their own and just steps into your place in owning and running the business. There's benefits and there's two sides to each transaction. It just depends on the intent of the buyer. Asset purchases are a little cleaner because again you don't assume any liabilities or they don't assume any liabilities of the organization. Stock transactions tend to be a little bit more complicated, but there are definite reasons to do both.
Yeah, because keeping in mind a stock sale, the new owner is going to assume those responsibilities 9 times out of 10, unless there's something drawn into that agreement that is going to preclude that. But and what you don't want to do is you don't want to buy a business from a very trustworthy person that's doing everything right, and then a year later get audited by the State Department and find out they should have been doing sales tax for the last 10 years. Nobody knew that. Nobody understood that. It wasn't a malicious thing. It wasn't on purpose. Now all of a sudden, this new owner has $1 million or $500,000 or $100,000 tax liability that they've got to pay that they really didn't have any part of. And so those are the types of things you really got to think about. When you go into selling or buying a business, is do you want that right? Which way do you want to organize, as a stock sale or the asset sale, like Greg had mentioned? Both have their benefits. It's really important to look into those and really determine what the negotiation is going to be. The negotiation might be that, hey, if we do a stock sale, then maybe you don't get as high a premium, for it. Maybe the multiple is not as high. Maybe if you do an asset sale, because again they're taking on, you're keeping the liabilities, maybe you get more of a premium or whatever that might be. So that's again part of the negotiation is how it's structured, but it's really important to understand the pros and cons to both.
I also think with that too, I think that the part of the negotiations is understanding where people are going to stand afterwards, right? Like, so you want to make sure you're thinking about that as well, especially you as an owner. Like, some owners are going to sell and they're like, I can't wait to sell and get away and walk away and just like walk away with my money and be done with it. And some owners might be like, yeah, I want to still be part of the business. I just don't want to run the business and be the owner of the business. So maybe they can put you in a VP role, or what is your deal going to look like afterwards, but not just you, but everybody on your team. What are your employees? Are they going to come in and they're there to, this is true for a lot of companies, but they're there to save as much money as possible. So they're going to run you a lot leaner than they were before, and they're going to cut your staff by some percentage because they think you're inefficient. And so you got those are types of questions you can't get guarantees on, but you can ask about, and you want to make sure you're thinking about at least the highest level and get an understanding of what it's going to look like all the way down the food chain.
Jamie, that just raises another thought. If and when you get to the point that you are talking about or thinking about selling, one of the things that I've seen, and certainly we did when I was trying to sell the company that I was last with, is cost reduction. And just running as lean and efficient an organization as possible. Sometimes we get so caught up in the sales and the revenue side of the business that we take our eye off the cost side of the business, or, we've had some great growth. One of the phrases we use is that revenue hides mistakes, or revenue hides problems. So if your revenue has been growing, your cash has been good, there still might be some opportunity to trim your costs. And so, when you look at, presenting financial models, you want to be continuing to show improvements, whether it's in gross margin or whether it's reducing operating expenses. So, just continuing to always keep an eye on, your utilization rates. Do you have excess capacity that's out there, to, right size the company continuously. And that just, doing it all the time is much better than doing it, and making a big, huge change at some particular point. But so always just keep an eye on, your metrics, your KPIs, understand where you are relative to the rest of the industry. Anytime that you can beat the industry stats, then, that's always a positive.
And understanding
I'd
those
add one
ratios
thing.
too. That's what I was going to say. So like, if you're talking about average bill rate, and right now for the past 3 years, your average bill rate has been 125, and then you're going to show your projected revenue, and you're going to say our average bill rate is going to be 175. Again, that's not a problem. You just be able to explain it. Okay, how are we going to increase our bill rates by $50 an hour? Okay, instead of going after startups, we're going to start going after enterprise companies or something like that. Or marketing. I think marketing is a huge one. Like if you're going to plan on growing your revenue by, doubling your revenue, and you're only going to increase your marketing costs by 5%, it's like, okay, how are you going to have marketing be 10% of your revenue now, and then it's going to be 5%, but you're going to have this growth? And you can have those things in your forecast. You just need to be able to explain them and be like, okay, here's how. Because instead of doing our marketing internally, we're going to go to this company who's going to do it for us, and they show these times of returns. And so again, you're allowed to have those things. You just have to make sure you can explain them, because I guarantee anybody that's buying your company is going to ask those questions.
Yeah, and I'd also say make sure that you know what ratios and what KPIs and everything that a prospective buyer is going to be looking at. Are they really, is the EBITDA, the earnings before interest, tax, depreciation, amortization, is that the main focal point, or are they really only looking at revenue? Are you a product company and they're looking at revenue, and they're looking at revenue growth, they're looking at churn? What exactly are they looking at? Because a lot of times you get those ratios and you get kind of blinded because there's just so many out there. You have no clue how to read them half the time. But what are the important ones, and what should they be reading? And so that's the importance of having that either on staff CFO or virtual CFO like us that can really kind of be beside you and know what those are, so that we're constantly looking at it, constantly making sure it's where we are, so that we know when the right time to sell. Because again, it's like the stock market. You never want to sell, when it's way down. You want to sell when it's up, and it's really hard to do that a lot of times, because you always think, oh, it's going to go higher, it's going to go higher. Is it going to be the next Microsoft, that type of thing, or the next Apple? So you have to know when that is, and then you have to be happy and satisfied when you do pull that trigger. But the key there is knowing what those ratios are and knowing what they need to be to maximize the value of your company.
Mm-hmm. Cool. So we are right on time here, so I want to make sure we give both you guys a chance to kind of throw some final thoughts out there. So Greg, let's start with you.
Just going back to my opening comments, keep your balance sheet really clean, and make sure that your CFO or VCFO controller is reporting into you on that, making sure that there's nothing hidden, either assets that don't have value or liabilities that haven't been recorded. That's where it starts. And then I think just making sure that you've got your documentation, whether it's employee contracts, customer contracts, HR policies, making sure that that's all taken care of, lined up, and organized. That's the way to success.
Great. What about you, Jody?
Yeah, kind of adding to that again, I think it comes again having that trusted advisor. I've said I think three times during this, and it's never too late to get that. So if you're in your prime, you're looking to eventually get out. Maybe you've got somebody, a relative or somebody you want to sell it to, or maybe you've got identified employees, or maybe it's completely a third party. I think it's super important. It's never too late, I guess, to get it. And the too late part's probably when you have the LOI in hand. You're like, oh no, now what? That's probably the too late. But prior to that, I think it's important that if you're even contemplating that over the next 3, 4, 5 years, or even sooner, get that trusted advisor by your side. That way, that you can kind of build the roadmap to get that highest value.
Great. Yeah, and I think definitely my final thought is something I've mentioned several times too. So, broken record here, but I think that getting organized, again, it helps you run a better business. And you never know what's going to happen. No one can predict the future. I always say, like, I love my house, I love my neighborhood, but if some millionaire knocked on the door and was like, I love your garden, I want to pay $2 million for your house, I'd probably be ready to move. And so you want to be prepared for that. You want to make sure that you don't have a bunch of faucets that don't work and stuff like that. So you want to make sure that everything's ready, because you can't predict the future. You don't know what's going to happen. Someone might fall in love with your business and give you an offer that you can't refuse. So you have to be ready for that at all times. Cool. Well, thanks a lot, Jody, Greg. I think this is a great conversation, and hopefully our listeners enjoy it.
Great. Thank you. Appreciate it.
Enjoy this podcast? Visit our website at summitcpa.net to get more tips and strategies for achieving business success. We're here to be a resource in this ever-changing industry.